eye on the lobby and admit people to the lobby as and when they come in there. So over to you, Graham. Hopefully you can all see our presentation slides as well.
Thanks for that, Vix. Yeah, this particular webinar is we've got a couple of outsourced sort of speakers. So we've got Ian Kelly from Davies, Tracey, who's the tax partner, and we've got Andy Lee from the Ralstan group. So I know both of these guys very well. We've worked with them over a few years, and the idea of today's session is just really to throw a variety of ideas across as to where we think things may well change going forward. Obviously, we haven't got any crystal ball, so my session is going to be relatively short. I'm really just going to say a few bullet points about the areas of where you should be looking to do before the end of the tax year. And then the other two guys are going to have some thoughts in terms of what may well happen. So I'm just going to give you a whistle-stop tour of the sort of things that we should be doing in the current tax year. Then hand over to Ian, and then finally Andy to say questions at the end. We're notoriously busy for February and March anyway in terms of pension contributions. It's always a hot topic in terms of the amount that you can actually contribute. If you are in employment, it's £40,000, but you would think that is relatively straightforward, but we then do have something which chancellors and governments seem to do, that they just seem to complicate matters even further by introducing a tapering and an earnings cap situation. So whilst I'm saying 40,000, it's remarkable how many people can be caught out inadvertently by making contributions. Also bearing in mind that your pension contributions is based on your overall sort of earnings. Some of the things we come across is where clients say, oh, I forgot, but I've got 2 or 3 properties that get rental income, and that just has to be added in. So beware of that. Utilising your personal allowance, why is that important? Some people who have retired early, who maybe have got other investments, don't necessarily make use of the personal allowance or claim the marriage allowance if the spouse isn't particularly working, whereby you can take money out of certain investments, and in particular your pensions. ISA contributions, £20,000. Some people again say, what's the point of making an ISA contribution? Rates that we're currently getting in cash are so low. Does it make any sense? And I don't necessarily want to go into a stocks and shares ISA because of the volatility. Stocks and shares ISAs is just a word. It doesn't have to be volatile. There are certain smooth funds you can use. You've got a whole host of different areas. So it isn't just a case of no investment risk and high investment risk, and if you don't use it, you lose it basically. So again, it's another area in terms of developing a pension pot. Ian's going to talk a little bit more about capital gains tax, currently 12,300. So again, people who are sitting on losses, maybe from a portfolio or a little bit of gains, maybe wanting to do something before the year end to rebase levels in the current tax year. In portfolios, VCT and EISs are considered again to be towards the riskier end of the area of the investment spectrum. In portfolios have become a little bit more of a player, because if you hold an AIM portfolio for more than 2 years, they do not count in terms of inheritance tax. So again, it's not necessarily suitable for everybody, but again, as part of planning, we do have another webinar that one of the VCT providers is launching for clients on Monday. So if anyone's interested in understanding a little bit more of the concept of that, let us know, and we can get you an invite in terms of that. The point I want to make is, just because they are yeah, some put into investments for a variety of circumstances. We've mentioned on there about wills and of power of attorney, and don't necessarily want to be the Grim Reaper, but these are important things, not just by the end of the tax year. It's also to do with just how things actually happen. Just to give you a couple of recent examples in the last 2 to 3 months, I've had a friend stroke client who was diagnosed with a critical illness. He got payment for that, put the money into a bank account in his own name, and sadly had a heart attack and hadn't got round to making a will. So all of those assets have been frozen until such time as the family then get probate. And the other area that I just wanted to touch on was the power of attorney. Again, someone who I know came to me, who is one of my running friends, being diagnosed with dementia, and asked me what impact that would have on his pension. And basically, because his pensions are all in his own name, if his conditions is to deteriorate significantly, it could mean that he couldn't get his hands on them, or his family couldn't get his hands on any of the monies to maybe fund future care. So we've put in place getting power of attorney in place while he has still got some capability. So again, not things that you should be doing just because it's the end of the tax year, but it just happens that it coincides with all of the other things. So that's all I really wanted to say, is a whistle-stop tour of what's currently available in the marketplace. I'm going to now hand over to Ian, but we have got our next webinar planned for just after the budget, so we'll know what the Chancellor will have said, what is likely to be implemented, and how that will affect the various investments after that date. We've also got a guest speaker, which is from the Bank of England. So Ian's now going to explain some of the things in terms of what the impact may well be. Ian, as I say, is the tax partner at Davies, Tracey, which are local to our offices, but they advise clients up and down the country, on a variety of the company's financial situation and doing the accounts for those as well as individuals. So I'm pleased to finish my little bit and hand over to Ian for the next bit. So over to you, Ian.
Yeah, thank you, Graham, and good afternoon, everybody. Wish we could be sat in a room somewhere to make it a little bit more personal, but it is what it is. By way of background, yes, I'm the tax partner at Davies Tracey and joined the firm in July 2018. Background is started career with what was then the Inland Revenue, joined private practice in 1984, which is a long time ago now, and I'm still in private practice. What we'll do for the next sort of quarter of an hour, 20 minutes, is to have a little bit of fun, hopefully, in trying to second guess what the Chancellor may come up with in the budget on the 3rd of March. I think this time last year we had a game of budget bingo in here and on the website to try and predict what we thought might happen. Of course, we had Sajid Javed, I think, initially in place when I played that budget bingo, and we then had a similar go of sort of tic-tac-toe in November, only to find that Rishi Sunak cancelled his autumn statement come budget. So there'll be no surprise that some things that we'll talk about today are habitual entries in budget bingo. Let's see what we find out on the 3rd. It's Sunak's second budget. Last year's, he was sort of thrust for his debut budget in front of the cameras at pretty short notice when Javed resigned. And then, of course, he had the pandemic to deal with as well. He had a summer statement in July, which was touted by some to be a budget, but it wasn't. And then he said, yes, we'll have something in sort of November, December time, only to pull the plug on it. I find him an interesting man. I think his manners quite easy on the eye. He comes across really well. And he's a bit of an antidote for the Prime Minister, really, in that regard. I think it's standing. Some people say it has improved over the course of the pandemic. And he's a bit of a calm and collected sort of bloke. His critics will argue that he's done nothing that no other Chancellor would have to do or be forced to do in the circumstances, and it's very easy to spend other people's money. I only learned at the weekend, somewhat naively, that he, as well as having a privileged background himself, his wife actually has more money than the Queen, which is an interesting concept. He's now got upwards of £200 billion to try and repay. And in the light of the high street still struggling, people losing their jobs, people looking to spend money that they may or may not have for very much longer. And of course, he has various support programs underway as well. The latest job retention scheme is up and running from this month to the end of April. So is the self-employed scheme. However, those people who have been also watching the news, reading in the papers, he is yet to announce the terms of the new self-employed fourth element of help, but he's promised to say something in the budget. Problem he's got, of course, is how much longer can he keep on going with this measure of support, but which is obviously really vital to a lot of people and businesses. We also have his temporary reduction in VAT on the hospitality and leisure sector due to run out at the end of March. An interesting sector there, because obviously that decision was made at the time where he was trying to encourage pubs, gyms and restaurants to stay open and do business, but they're open 1 minute, closed, open, then closed again. So the actual effect of that VAT remains to be seen. And we have a stamp duty land tax freeze due to be lifted at the end of this month as well, next month I should say. So we're going to look at, as you see on the screen there, some predictions, and these really are 5 habitual offenders, as there were, which, if you're talking to pundits and accountants at this time of year, are always going to come up to some degree. Now, next slide there, please, Vicky. Thank you very much. So this is where we are currently, and I'm starting to say, is it going to be an attack on these rates? It's important to probably point out straight away that the 2019 Conservative Manifesto made a commitment not to increase income tax, national insurance or VAT in the lifetime of this Parliament, which is due to run to 2014. Sunak could quite easily turn around, of course, and say the goalposts have moved and the pandemic has changed everything. But one of the last major successes of the last Conservative government was they did commit by the end of the last Parliament to effectively have a £50,000 starting rate for higher rate tax, which they achieved with a £12,500 personal allowance and a £37,500 basic rate threshold. Having achieved that, we found in last year's budget that Sunak retained the same level of personal allowance and the same level of basic rate. What's interesting on the £50,000 mark for 2 reasons is that, yep, you're starting to pay a higher rate tax at that element, which in these days and age isn't a massive amount of income in some sectors, but it also means that the minute you pass £50,000, if you're a child benefit claimant, you do start to lose entitlement to that benefit, which I think when it was first introduced probably couldn't be foreseen. So we look at the income tax rates there. In the olden days, certainly when I was sorting the revenue and starting private practice, if you want to raise some money reasonably quickly, you'd put 2 or 3p on the basic rate of income tax. Old-fashioned concept, really. Seemed to work well, and then all that they would do for the 3 or 4 years is chip away and take a penny off and a penny off until election year, when things looked a lot more happy for people and a bit of a giveaway budget. I think times have moved on, and I'd be more surprised if he was to go down that route. I really would be. But those rates are there to be tinkered with, either to a degree, or does you bring in a 50% rate for the really high earners, for example. Employees' national insurance of 13.8%, you would think in the current climate that he would leave this well alone. However, national insurance is an easy target, and employees' national insurance to boot, and it wouldn't surprise me if you found that tweaked by 1%. Corporation tax, similarly interesting concept. It's hard to believe now that back in 2010, this was at 28%. So it's been eradicated over a period of time, and it was due last year to drop down to 18%. But Sunak reversed the planned for reduction and retained at 19%, although some people, myself included, thought that 19 would have become 20% in last year's budget. It didn't. But again, a bit like the employers' national insurance, you can see a penny or tuppence going on to that rate, which obviously won't please businesses whatsoever. But in the marketplace and the public eye, you would probably find that, yeah, there's no reaction or no argument at all from the layman on that point. VAT, all sorts of potential issues with VAT. I've already mentioned the reduction of hospitality, and obviously the whole area of VAT was one of the key parts of the arguments over Brexit, of course. So having those two rates there, zero rated tends to be things like there's no VAT on books, journals, transport. 5% we've said is linked to, at the moment, the hospitality and leisure sector, but also includes things like children's car seats, for example, is one thing in the 5%. And then, of course, we have the 20% standard rate. And again, a bit like the income tax rate and national insurance, over time, yeah, the standard rate is shifted around a little bit. We've had 7.5% rates, we've had 15% before we've got to those current three rates. Inheritance tax, yeah, 40% for quite some time now. School have thought that yes, he could push that up to 50%, and again without much resistance from the rank and file and the man in the street. What do these potential rate changes mean? Well, certainly for individuals, we could all see less disposable income in our pockets. And for businesses, sadly, who maybe are wanting a bit of support and an arm around the shoulder at the moment, could find that their costs increase and their tax hit does at the same time. Could we move on there, Vicky, please? Thanks so much. Yeah, dividend taxation is another interesting concept. Obviously, a lot of people who own and manage businesses using their own limited companies tend to have a package in place based on a relatively modest salary augmented by monthly dividend payments. The last review or overhaul of dividend taxation saw that what was the 10% deemed credit on dividends abolished. And at the same time, we brought in a three-tier tax rate system designed to more or less sit alongside income tax rates, and a bit of a sop in that they gave people a £5,000 exemption, effectively, whereby the first £5,000 of dividend income was exempt. It's a bit of a sop, and maybe designed to sort of counteract the initial sting in the tail, which was for people paying at the basic rate. Whereas in the old regime would pay no tax on dividends at all until they hit higher rates. There was then a 7.5% dividend charge for those people within the basic rate threshold. So it started life at £5,000. Was then reduced almost straight away to £2,000. And I think we all thought, or certainly over the last 2 years, that £2,000 would go altogether. It hasn't, it's still with us, but again, that would be an easy win for Sunak to say that, yeah, any dividends are taxable. And you could argue that the £2,000, yeah, isn't a huge allowance or threshold whatsoever. So one thing to look at is, will he be bold and look to tax dividends at or near to income tax rates? Reason for this is, we've already mentioned about people's packages and that it's structured around a salary and dividends. And yes, as you say, there is tax concessions to be had there, more money in your pocket by taking more in dividends than salary or fees or a bonus, for example. So we've got dividend rates of 7.5% for basic rate taxpayers, 32.5% when we jump up to 40%, and then 38.1% for those paying tax at 45%, which comes in at a chargeable income of over £150,000. So still a nice little differential there between dividend rates and tax rates when you come to produce your package. And for those people sort of new to trading as a limited company or the younger generation, those dividend rates may be all they've seriously ever known. For us older people who we used to more attractive dividend scenario, for example. Yeah, they are maybe a little bit too close to the income tax rates for comfort. Although that said, the other boon is there is no national insurance contributions currently on company dividends. Again, a habitual point which is raised by commentators and pundits is they expect national insurance to be imposed, and again, this could be the year where the Chancellor sort of bites the bullet and brings in a national insurance charge. A halfway house would be to very kindly not charge employees on the dividend income that they're receiving. But yes, a poor old employer or company is probably ripe for employers' contributions. And he's got a semi-foot in the door here because benefits in kind carry a 13.8% rate of national insurance contributions. And it'd be very easy to say that that same benefit in kind national insurance rate would also apply to close company dividends. So what we're looking at there, well, certainly the efficiencies of dividends over payoff fees could be further eradicated. And from a planning point of view, do we accelerate dividends from post 6th of April this year to pre 6th of April? Possibly a contentious topic in some areas, and that obviously we've had almost 12 months now. I've called it austerity, but really it's a pandemic, but similar to austerity. And as you say, are the figures there? Is the cash there to justify dividends? Is the cash more required as working capital, for example? Can I just move on there, Vicky, please? Capital gains taxation. This really is the hot topic and hot potato at the moment. Got to be viewed as a tax ripe for change. And I say that because for the last sort of 6 to 8 months now, the Office of Tax Simplification has been working on a paper for the government on the overhaul of capital gains tax. And I think, again, if you read the papers, listen to the TV, this is the one tax really where we're expecting potentially some major changes. So I think on one of Graham's earlier slides, he highlighted that the current annual exemption is £12,300. So you need gains of over that amount of money, ignoring maybe any available losses, before you'll pay some capital gains tax. Some people are saying, will you abolish it altogether? Sounds a bit draconian. So I've sort of hinting at there that you may well think, well, yeah, I need to reduce it a little bit. Do I go for sort of £5,000 or £10,000? Nice round sum exemption, which again will give some people a little bit of latitude, but again will increase the tax yield to a degree. One of the surprises in a way of last year's budget was that the bit of tinkering with what was then called entrepreneurs relief, which was a much easier way of saying the business asset disposal relief. At that time, we had a situation whereby we had a 10% capital gains tax rate for entrepreneurs relief and a £10 million lifetime threshold of gains. Probably fair to say that both of those items, the 10% rate and the £10 million lifetime allowance, could be viewed as being overly generous. Sunak agreed, I think, with that contention and came up with a change to the lifetime allowance, which is sort of slashed from £10 million to £1 million, but still for most businesses, a reasonably tidy sum. But he did retain the favourable 10% capital gains tax rate. Hard to see what he can do with the lifetime allowance, short of abolishing it altogether. But I think he could do something with that 10% entrepreneurs relief rate. So I've lost my slides there. Move to paper. We're struggling there, Vicky, still? Okay, I'll plod on.
Can everybody still see the slides?
No,
I can just have a thumbs up, Graham. No, they're gone.
Oh, all gone.
2 seconds. Is it back?
Yep, brilliant. Yes, thank you, Vicky. Yeah, where were we? Yes, we just finished with the 10% rate and the lifetime allowance. The other thing to consider is, does he increase capital gains rates to or near to income tax rates? We've had a similar discussion already on the merits of dividend taxation. So at the moment, we've got those rates of capital gains tax. So we've got 10% and 20% as your routine rate. So it's 10% for those paying a basic rate and 20% for those in high rates, or you could have amalgam of the two. So you'd be taxed partly at 10 and partly at 20. And we have two hybrid rates of 18 and 28%, which are higher rates, which apply to gains on residential property. So residential property owners, and chiefly landlords, have had a bit of a hard time of late with various constraints put in place by way of mortgage interest relief, last period of ownership, and a higher rate of tax to pay as well. So we're going to compare those capital gains rates to the income tax rates alongside of 20, 40 and 45. Again, we spoke earlier about the changes in the level of corporation tax. We've got something similar in capital gains tax, really, and you only need to go back 10, 12 years to find that the rates of capital gains tax then were 10, 20 and 40%, which was sort of the income tax rates at the time. And you would pay capital gains tax at the same rate of tax as you would on income. So again, the perception is that the capital gains tax rates are generous, especially when viewed against income tax rates. And I think a lot of pundits are expecting him to move those rates a little bit higher. What would that mean? Well, for those people who are trying to derive some or a lot of their income from capital, the differential is going to be eroded. And for the poor property owners, whether it be landlords or second homeowners or investment properties, those 18, 28% rates, which are already higher, could well be stretched a little bit further. So a bit late in the day to try and accelerate any planned sales from next year into this year. But those who were able to maybe complete, let's say ahead of 5th of April initially, but arguably you may well want to consider it ahead of budget day or 6 p.m. on budget day, perhaps. Maybe that's a point you need to take a look at. Thanks, Vicky. Inheritance tax overhaul. People argue over the merits of inheritance tax, what it means, number of estates caught, the tax. And the first thing that I've sort of highlighted is we've got a current freeze for another 2 years yet on the nil rate band of £325,000. So the usefulness of that is being eroded in cash terms. We also have what's called the resident nil rate band. That's currently £175,000. So that would give you a £500,000 total exemption, or £1 million exemption for a married couple where on the first death all of the assets are left to the surviving spouse. The residence nil rate band is transferable and it's in place to be claimed, and it has to be claimed, when your home is left to a combination of children and grandchildren. So you have to do something with your home to get this £175,000. And as you say, that £1 million potential estate allowance is available on the death of the second spouse. What's come out so far from the commentaries? Well, there's talk, as we've had with the capital gains tax changes in general, that will soon scrap the capital gains tax uplift on death. Again, quite an easy win, and at the moment, for most states, yes, it's quite a nice thing to have. On the basis that most assets, you'd like to think of it of appreciating value between purchase and date of death. That probably is one where you could easily win some points by doing that. What would it mean? Well, if you do have an uplift on death, you'd have lower base costs when the recipients of that asset maybe decide to come to sell it. What that means, higher capital gains tax. And we've already looked at the fact that not only mean maybe higher rate capital gains tax, could be at increased rates at the same time. Talk of an annual gift exemption, and I put £30,000 in there because that's the figure that seems to be touted around. And there maybe is some merit in that £30,000 allowance, albeit it would be at the time of the death knell for the current gift structure of the £3,000 per annum, the small gifts of £250, and marital gifts, for example. So I think to gain the 30,000 or maybe whatever that figure might be, we would lose some of the more modest gift exemptions. Could do some tidying up IHT, certainly, and maybe that £30,000 is just a start. Working on the basis, that's our lunch van arriving, working on the basis that £30,000, you could gift more than that, but obviously, can you still hear it? Always comes at an inopportune moment, and the windows are open as well, so sorry about that. Yeah, so you'd like to think that that £30,000 could be a start for 10, and that you'll see it increase over time. View against that the fact that the revenue tend not alike to increase exemptions. So you look back years ago at the old PLMD higher earning level of £8,500. You look at things like your car mileage, which has been 45p and 25p forever and a day. So sometimes get these tolerances or thresholds in the head, and they never ever move. What's it mean? If you're looking to make maybe significant gifts, yeah, maybe do it ahead of the budget, unless you think that you know, a clamped down figure or an exemption would help you. Talk to an advisor, because you see these are anticipated changes. As you say, they do carry risk if you do what I've said there, and we find out that soon after does nothing at all. However, it is thought that there could well be some merit in some of those bullet points. Yeah, another habitual offender on the budget bingo is personal pension tax relief, and I think every single year in living memory, as far back as I can go anywhere, there is talk of abolishing higher rate tax relief on pensions. Well, how would you do this? Well, you get 20% basic rate relief at source on your pension contributions, and limiting it to that 20% would be an easy way. That said, the successive governments are trying to encourage people to provide for their retirement. So to sort of abolish higher rate relief in some regards would be anathema, but there is a bit of a groundswell that says that yes, you know, that maybe is too attractive relief. And you can see from the third bullet point down that the cost of that higher rate relief is £39.9 million. We do need to view that sort of saving to the Treasury against the incentivising of people to provide for their retirement. I put higher rate tax chasing as bullet point 2, and that's quite a new addition really. And I was reading at the weekend that HMRC are planning to actually chase up higher rate taxpayers who are paying personal pensions but not actually claiming that additional 20p relief on a tax return or in the code number. Sounds very philanthropic that you'd be paying high rate tax at 40%, not wanting to claim that relief, but the HMRC think there's a significant number of people in that particular boat. What might you do instead? Well, why not bring in a hybrid rate so he splits the difference? So the 30% is get a little bit extra relief for the high rate taxpayers, so they're not losing everything. But the differential between the basic rate and high rate taxpayers has somewhat been reduced. An interesting concept which saw the light of day probably about 2 years ago now was there was a bit of a drive to say, well, instead of giving people the tax relief when they're paying the premiums in, is why not flip it on its head and give the tax relief when people come to draw the pensions and when arguably some form of tax concession might be more desirable or useful to people. What could this mean? Accountants and tax advisors are very much in the lap of the gods in help and needing help from pension advisors. Pension advisors need help from accountants, and the true picture is probably yes, it is a team game. Pension legislation continually changes, isn't the easiest to follow, and I think we've seen certainly from talking to some clients that over the last sort of 8, 10, 12 months of the pandemic, people have been not only dipping into the cash at bank, but also into the pension pots as well for help in bills, mortgages, in existing and living effectively. So some overhaul along the lines of those bullet points could well be quite welcome, and maybe a more straightforward and simpler set of pension rules will be to the benefit of everybody. So to conclude, just to remind you that, yeah, I'm not on the phone to Sunak. He doesn't talk to me, and these are just my suggestions and predictions, some of which are new, some of which habitually roll forward from budget to budget. There are always surprises or omissions that you would expect to see in the budget, always something a rabbit out of a hat. Sometimes some of the bigger stories or changes take effect from 6 p.m. on budget day. Usually it's from the following 6th of April or 1st of April for companies. Please take guidance from your tax and financial advisors before taking any action at all. And the final throwaway line really is, I did read somewhere where Sunak was going to say all sorts of things, but then in view of the current difficult circumstances, he would actually make no major changes before 6th of April 2022. That would be, I think, a proverbial rabbit out of the hat, and I can't see how on earth he could do that. But that said, he had a chance to interject last autumn with a budget and chose not to do that. So he makes the rules. He may well decide to do that. That's me done. Thank you for listening. I hope there's been something of interest in there for you. And I'll now pass it back to Graham.
Cheers. Thank you for that, Ian. Our last session, and then we'll go on to the question and answering, is that we have a lot of people who say to us in passing that I don't really have a lot of money in my pension, so I'm not too bothered about that. My pension is my various properties, and Andy Lee, who I've known for a number of years on a variety of things where we've been looking at tax planning for some clients, he's now going to spend the next few minutes talking about property ownership and potential taxation consequences, because it will resonate some of the things that he's going to talk about with a lot of the people who are involved in this seminar today. So over to you, Andy.
Thanks, Graham. Just loading up the slides. Here we go. So hopefully everyone can see those and we don't get any more match of the day music in the background and ice cream orders. So yeah, thanks, Graham. So my session is on property ownership and taxation, which kind of hopefully dovetails nicely into what Ian's covered. Property is a major asset class for people with their homes, and again the rental market in the UK has always been very strong, and as Ian hinted at, it's become a bit of a target for successive governments. So I was just going to spend a bit of time on some planning ideas that we see on a regular basis. So I'll run through some of these ideas. Just a bit of background from what Graham said. I run a business called the Ralstan Group. The other picture on there, and the lady you just saw, is Michelle, my daughter, who works closely with me. And we sit very much next to people like Graham's business at Prismatic and Ian's business at Davies, Tracey, where we provide international and UK planning expertise, both tax and structuring. This involves a lot of structures like trusts and other estate planning that we get heavily involved in. Also management of companies and administration of businesses, but also we have on the side of our business a UK law firm. So very much echo what Graham said about things like wills and powers of attorney. There's been a real life admin issue, I think, with COVID, as people want to get their affairs in order. And we constantly see people whose affairs have not been properly planned with what's happened, and it's caused some big problems. Again, I do a lot of work internationally. So, one thing we've not touched on here at all, and if Rishi Sunak is too aggressive with changes, there is behind the scenes, really unspoken, there's a bit of a Brexit effect going on with people who are fearful about the future tax position in the UK and are on the way out. So we have been dealing with quite a few people who are seeking advice around non-residency. So we work closely with the guys at Prismatic and Davies Tracey in areas like this: complex estates, people with wealth above the inheritance tax nil rate bands, liquidity events. I've been on the phone this morning with a guy in East London selling a fire safety business. Even in the current climate, there's still plenty of business sales going through. Clients with, asset rich headaches, really, a lot of property, not sure what to do. assets abroad as well, trying to tidy up their affairs overseas. This often leads into people wanting help with residence and domicile, and then working very closely with people like Graham's team as go-to advisors. And we've been talking for the last year about our own version of PPE. You know, ours is planning and protection for your estate. We think has really echoed the sentiments that we've been facing these last, 12 months. So most clients who will often look for our help are either involved in some form of exit strategy, as Ian's highlighted already, issues about capital gains tax changes, those worried about succession. Again, inheritance tax, very tired piece of legislation, ripe for reform, but has the government got an appetite to make major changes at a time like now? And Ian's highlighted most of these points. This is our confusing planning landscape. A death tax at 40%. It's been around since 1984. It's ripe for reform. There's all sorts of, sticking plasters around changes in trust taxation, pre-owned asset tax, combining of nil rate bands, the residence nil rate band. And then you've got this disparity with capital gains rates at 20 to 28%, a 10% rate for business owners, all the changes that Ian's highlighted. So it makes for a real minefield, we find. And, Rishi might have his checklist. Ian's not touched on the fact that, are we destined in the country, for some kind of asset grab, like a wealth tax, potentially, which politically could be very dangerous, but must also be very tempting. Ian also touched on the fact that property seems to have become a very targeted area. A takeaway from today, perhaps, is that incredibly, we've had 14 tax changes to property in the last 7 years, and these are just some of them listed here. And as the headline point highlights, that if it doesn't move, tax it. Are we moving as a country to taxing assets, not people? Property is a great example of this. So some of the things we've seen changing there, many people are falling into the trap with the sale of an asset that capital gains has got to be paid within 30 days now of a property sale, not under self-assessment. Point 4 there, a lot of people historically with property gains would have left the UK and avoided capital gains by being non-resident. So guess what? 5 years ago, the government introduced a non-resident capital gains tax to tax gains since April 15, but not before. The 3% supplement on the slide down below there on second purchases, and also a plan for foreign buyers, expats who live abroad who want to buy UK property, but from the 1st of April, they'll pay a 2% surcharge on property purchases. And then a final big one for a lot of landlords, second last point about mortgage interest deductions on their loans not being allowable anymore against income tax. So we've seen a lot of issues. So a lot of landlords are probably coming to talk to people like us and Ian and Graham over how to be more tax efficient. We have produced a bit of an infographic here, guys. So if you want this perhaps as a handout, as a follow-up from today, some more detail about these changes is available. So please perhaps let Vicky know if you want a copy of that shared. So what I'm going to do just for the next 10 minutes or so is just run through some case studies of the kind of things we're seeing people do. So when I do presentations, we've often found case studies work well. So we have our make-believe fortune family. So the fortune family allow us to just highlight particular ideas we find that are very topical, or there's a flavour to certain actions for them. So the fortune family for us, we've got a series of emails and of case studies, and I'm just going to pick on 3 for today. The first one, if we take our couple Edward and Karen, is something I often call a freezer trust with holdover relief. And the scenario here, if I move to the next slide, is very much around, we see a lot of clients who've got rental properties. They've done well in terms of capital values. As you can see here, we've got a couple with 3 properties with 600 grand, but a 400 grand gain. Now, as Ian's highlighted, if gains rates are going to be aligned with income tax rates, not great for people who are planning a disposal. But also, one trap many people fall into with doing some estate planning is that, incredibly, a gift of property, an outright gift that's on your 7-year gifting clock for inheritance tax purposes, is a disposal for capital gains tax. And yet, strangely, a gift of property into a trust doesn't trigger the capital gains, because of the availability of something known as holdover relief. So holdover relief is the opportunity to roll that 400 grand gain into the trust. It doesn't go away, it just becomes a liability for the beneficiaries. But the clients that kind of do this are often looking for that compromise between some lifetime estate planning to minimise the 40% inheritance tax liability, whilst deferring what is at the moment a lower tax liability. Now, this might get neutralised as a piece of planning if gains rates increase, but where I also use the concept of a freezer trust is if clients are confident that their asset values in property will grow, at least the growth is now outside their estate and frozen into the trust. So the kind of people this sort of thing relates to are those that are trying to do some lifetime planning. They might have some concerns about making outright gifts to the kids, you know, from an asset protection and a bloodline point of view. You know, what my wife often calls the add-ons. So your own kids are fine, but it's the in-laws and the outlaws that we sometimes are fearful of. So trust can be a great way of protecting that bloodline as a string of beneficiaries with assets like property. So at the moment, we can defer a capital gains rate of 28% on property to avoid a higher 40% inheritance tax rate. So this is a nice trade-off for some families. And we can do this up to our nil rate band of 325,000 per spouse for a married couple. And we recover our nil rate bands every 7 years. So we can actually repeat the process on a regular basis if we can afford to. And this is often done with rental properties, investment portfolios, and even shares in a family business. I had a call this morning with a chap about his mum who owns some of the shares in his fire safety business. And, you know, she's well into her 70s and realises that it might be a smart move to gift some of her shares into a trust structure for the benefit of her son and grandson. But it's also a good redistribution of income sometimes. So higher tax paying parents or grandparents might use a trust to push income through to lower tax paying beneficiaries, kids and their uni fees, grandchildren's school fees, things like this. And it may be an opportunity for those who are more inclined to look at lifetime planning. Now they can take advantage of this residence nil rate ban, the higher £1 million figure that Ian referred to. And as trustees, a trust is a great parking lot really for property and other assets. And the trustees, who often might be the parents, retain control. Again, if it helps, anybody wants it, we produce some sort of fact sheets on these things. So again, if you'd find it useful to have something like that, just shout. Now, if Edward and Karen can look at freezer trusts, we also found that couples like Gordon and Marie might want to consider some kind of freezer share strategy. Now, Gordon and Marie in our make-believe Fortune family have a limited company. Let's call it Fortune Design and Build. Classic scenario again we see here, a couple who perhaps have been builders over the years. They've developed property that they might have retained for rental purposes, and they're never quite sure about their trading status or investment status from a tax point of view. But you've got a business here worth maybe £1 million, but the couple are confident that with projects they've got in the pipeline, they could easily grow the value of the business, which just makes their tax planning more difficult in the future. And they've got John and Greg, their sons, involved in the business. So they've got this eye on trying to look at succession. Many ideas that we can relate to here with people, but the freezer share concept is nothing more than reorganising the shareholding that Gordon and Marie might have in this business and perhaps fix the value of their shares to this current value of £1 million. And if we can do this, we can issue a bonus share in this company for future growth. So if this business might be worth 3 million in the future, we've put a lid on Gordon and Marie's problem, and we've created a growth share that could pick up all future value that we might now decide to give away to John and Greg, or perhaps hold in trust as an asset protection vehicle to protect all that growth from things like inheritance tax. So the freezer share idea is, a well-trodden path. It's nothing new. It's not contentious, but also, as Ian highlighted, with perhaps changes in dividend tax, if we've now got 4 shareholders of this company, maybe we can spread the load in the future across family members, if there is a higher rates that might apply. From a diagrammatical point of view, that looks a bit like this. Putting shares in the freezer might mean that Gordon and Marie retain that fixed value share, and we've parked the growth shares in trust for John and Greg. And we're seeing at the bottom of that slide more and more this terminology used of a family investment company, almost turning a corporate vehicle taxed at lower rates into almost like a family fund. And I think as people are waking up to real generational issues, these are a great way of kind of like, spreading the load, if you like, from a succession point of view. So this leads me on to the final case study on property and taxation that I wanted to touch on. And again, very interesting area relating to, again, what Ian's talked about with capital gains changes potentially. But more and more landlords who run their businesses, their property businesses, are looking at incorporation. There's been a massive increase in the use of companies by property owners. 42,000 new companies formed last year by landlords. Property company use has doubled in the last 4 years since 2016 for property owners. And one of the reasons I think for this, if we take our make-believe couple of Colin and Diane, is the fact that here's a couple with a £3 million property business. They're a real mix of commercial, resi. They're quite active, this couple, managing this as a business activity, but they're higher rate taxpayers either from the rents or other income streams, and they've got significant capital gains. It's a real recurring theme we're finding for people, but it still seems to be quite unknown or little known that it's actually quite feasible within our tax system to use something called incorporation relief. And incorporation relief is this ability for Colin and Diane to tip their property business into a limited company in return for shares. And for that relief to apply, they don't suffer any capital gains on their historic stored up gains. It's rolled over and deferred into the shares of the company. The third point here is a really critical point we find in relation to the current situation we're in, which is that the company accepts all of the assets introduced into the business at their current market value. There's a form of rebasing that goes on here. So if we've got a business here worth £3 million, but the capital gains base cost was only, say, 1 million, the assets go into the balance sheet at 3 million. So if you've got a property that you're thinking of getting rid of, there's actually a way of actually uplifting your base cost into a company, then selling and avoiding the capital gains. It's a great way for some landlords to almost like recalibrate their asset ownership, and then perhaps go to Graham's team about what to do with the funds released. Or our couple, Colin and Diane, just carry on. They just continue as they are, but perhaps in a lower taxed environment. So again, just a diagrammatical view of that. That's how it looks. We've got a couple here, Colin and Diane as a partnership, who drop all their assets into a limited company in return for shares. Now, Colin and Diane in our example haven't got any kids, but are keen to make provision for nephews and nieces. So within the company formation, they might create a trust for a growth share, a bit like Gordon and Marie. Key issues here, if you're thinking about this, if this is of interest, is that the key hurdles we have to get over when we do planning like this is attitude of lenders for those who've got mortgages, and also trying to minimise the stamp duty risk of that incorporation process. But these are things that can be got over. So again, feel free, if you've got any questions in relation to ideas like this, please let us know. So just by way of a quick summary there, the benefits of people incorporating, if it's right for them, is the fact that lower corporation tax rates are meaning companies are becoming a capital gains and income store at lower tax rates. Even if the Chancellor increases corporate rates to say 23% that's been suggested, that's still a lot less than higher rate taxpayers paying 40 and 45. The freezer share opportunity opens up all sorts of estate planning and inheritance tax opportunities, coupled with the capital gains deferral and rebasing opportunity. Perhaps shares held in trust, tax efficient distributions through the company through various means. Again, Graham's team can then help landlords with pension planning for rental profits in the company. And incredibly, at the last point there, the mortgage interest relief changes that were brought in for personally held property by landlords doesn't relate to companies. So you can get all your mortgage interest relief back. So lots of kind of topical planning there. Very quick journey through areas that we can help with. As our slide highlights here, with no planning, it'll cost the family its fortune. Hopefully that sits nicely with what you've heard from Graham and Ian in terms of some topical ideas, and I'll hand back to Graham.
Thanks, Andy. Lots of interesting points and ideas there. Before we open it up to questions, we've had a couple of clients in the last week or so, and this is directed at Ian, who have worked offshore, have been forced to work from home. Is there any legislation that will allow that still to continue, or are they likely to be caught up with the fact that now they've become a UK taxpayer?
Yeah, two sides to that, Graham. For people who are affected by the pandemic, they are able to, if they are currently enjoying non-resident status, is they are able to tap into the exceptional days criteria of the statutory residence test, because where the Foreign Commonwealth Office advise against travel, which has happened to most of our citizens, the people are obviously unable to leave the UK. So as well as assuming you're using the 90-day UK day rule, you're allowed up to 60 exceptional days where you're prohibited from leaving the country. So you can have 60 exceptional days, anything over 60 exceptional days. So say if you've got 80, for example, well, then you've got the 60, but the balance of 20 exceptional days go against your 90-day normal limit. The second point to your question really is that if you've undertaken some work in the UK whilst stranded, you are caught a tax on UK work days, because it's income and earnings derived from physical presence in the UK. So if you've worked for say 30 days, for example, you need to assign a pay rate or an income level to those 30 days, normally using a day rate, for example, or apportionment of salary. And that income is then declarable on a UK tax return and potentially taxable. However, you will be entitled to the £12,500 personal allowance and the tax rate bands. So although you may well have a tax bill, there are ways, legal ways of mitigating it.
Thank you.
Do we have any? Sorry, I've got a question just on the meeting chat, which is, are there any predictions on duties, fuel, alcohol, tobacco, that sort of thing, Ian? Any ideas?
Lately, obviously, tobacco and cigarettes are always going to get at least inflation or 2 or 3 times inflation rises. That's just a fact of life. Latterly, there's been a degree of lenience towards the drinks industry, given the current issues with pubs, clubs, and restaurants, etc. You can see that happening. The sting in the tail, I think, might be that the vehicle, the fuel duty, which has been frozen for about 8 or 10 years now. You can just see that being lifted, which again is going to impact on domestic budgets, but obviously also for business as well, especially obviously hauliers, for example. So yeah, I can see him saying, "You've had a good run for your money on this. It's time to lift the freezing of it."
Thanks, Ian. Do we have any more questions? If not, I'm just mindful of time. We've just overrun by 2 minutes there. So if there are no more questions, I'd like to thank everybody for attending. As I said, we have recorded it, and as Andy said, there is some infographics he's got that he can circulate as well. So if you'd like any of those, we'll be sending them out. Otherwise, thank you very much for attending.